Good morning, Kevin Brierton here, your certified mortgage planning specialist and your no excuse lender. Wanted to come to you with an update on interest rates. Finally, this is September 6th. On Friday, yesterday, there was some great movement in the market as far as interest rates, but what's actually going on? So let's take a look. I want to share with you what's going on in the job market that's driving and fueling this rally in the bond market, which is pushing down interest rates. So we're going to kind of get a little geeky with the numbers for a little bit, and then I'm going to land the plane with some good information you're going to need to you can take to your clients and help them with what's going on. So let me show you with what's going on right now. But basically, what we've had is we've had payroll numbers miss expectations and fall to the lowest levels. So this is monthly job creations, and we've had a very low job creations number, the lowest in a significantly long time. Obviously, we had a few months miss here, and then pop back up. We have wage growth is way down, but the other one number here is unemployment rate. We haven't seen unemployment this high since it tipped right here last year, and then really hasn't been this high for multiple years, dating back into 2021. So this is a good sign that they're going to be lowering Fed funds rate, but we have to be careful on what happened in the past, and use this as an indicator of what might be happening now. And it is happening as well. So the Federal Reserve actually lowered rates in September 2024, and you would think that interest rates actually would go down this time, but they did not. They had already been priced in. So if we looked at the average 30-year average interest rates, when the federal funds actually lowered the rate was September 18th, but interest rates actually went up. They started their rise right around the 19th time frame, and then they dipped a tiny bit, and then they popped back up and took a massive rise up. So we have to be a little careful. Just because the Fed funds rate lowers interest rates, it doesn't necessarily mean they're going to be lowering the overall interest rate. So if we look at this history here, the Fed actually lowered the rates a few times throughout the year. But what happened throughout November, and we got a little bit of help in December, but interest rates kept rising as the Federal Reserve was lowering interest rates. And it's because a lot of the movement that gets priced in already gets priced in prior to what's actually happening. So if we look at the 10-year Treasury, and that's a good indicator of long-term interest rates, we had a nice improvement in the 10-year Treasury down last year in 2024. But if you look at September, we actually had a pop up. So 10-year Treasury actually increased right when they increased the federal funds rate. And this is a little bit better indicator on what's going on in interest rates is the 10-year Treasury. So 10-year Treasury went up after they raised they lowered the Fed funds rate. Remember, they lowered the Fed funds rate here in September, November, and December. But what was happening with the 10-year Treasury, which also happens to long-term interest rates, is it all went up. So now what's going to happen, this year as they move into a time period where they're starting to lower interest rates again, but we saw this big run down here where interest rates have a nice little movement in the last few days, but a lot of this is already priced in. So your buyers out there, be careful, because if they're waiting for the Fed funds rate to be dropped, which is just the overnight trading rate between banks, it's not the long-term interest rates. It impacts interest rates, but indirectly. So as interest rates improve, we can't assume that if they log another federal funds lower rate here, it doesn't necessarily mean it's going to directly impact interest rates or the 10-year Treasury even, because the 10-year Treasury has already had a huge run improvement. Back in just July, it was 4.4% for the 10-year Treasury, and now it's almost a half a point lower. And then we're seeing that in interest rates. We've seen that come down from June and July. We've seen higher 6% range, and now they're coming into the mid to low 6% range. So depending on obviously every situation is different. So we were using national averages, but it's all about unemployment. So let's keep an eye on unemployment. Let's keep an eye on what's going on with the consumer. So if we're helping consumers, it's not always just about the interest rate. I say the wrong interest rate with the lowest interest rate with the wrong strategy could actually cost somebody thousands of dollars over the life of the loan. because it's not just about interest rate. If you get the, let's say you time the market perfect, timing the market is extremely difficult, as you know, in real estate or stocks or bonds. Timing it is almost impossible. Just like this. So if you time it where you get a low rate, but then let's say you don't get the right house, you really want to get the right house. When you're buying a house, it's not just you're not just buying an interest rate. Nobody is getting a house just for an interest rate. They're getting a house because they actually want a house to live in. And it's not always going to line up perfectly with the charts and the lock rate, time to lock the perfect rate. Because what if that house comes available when rates are a little bit higher, but you want the house, right? It's about the house. It's not about the interest rate. So you want to get this narrative out to your clients, and you want to talk to them about making sure they know interest rates are improving, but it's going to be volatile. If we see an improvement of the employment numbers, think about it, as we come into the holidays, a lot of people get actually hired back on during the holidays. So that's what we saw like last year is the employment rates and the supply of jobs actually people were able to get jobs last year. So during the holidays, you actually might see a pop in the improvement in the employment rates. So that can actually hurt interest rates a little bit. So keep that in mind. They're also priced in. So interest rate changes have already been priced in. Make sure we're talking to your clients about that they're not just waiting for something that's just going to go down. And rates are trending down, but don't wait for the Fed. Jobs data is important, not just the Fed action that actually drives interest rates. And again, I can't reiterate enough, timing the bottom of the interest rate market is nearly impossible. So the best strategy is, find the right house and move on that house with the right strategy. So if you have people on the sidelines right now, let's get the message out to you. Yes, rates are going down, and let's revisit affordability. We have to talk about this. I provided a couple slides in the email and a couple other attachments for good information to share. So share this video, share the other attachments. Hopefully this is helpful with some data and information for you. Have a great Saturday. Again, Kevin Brierton, your no excuse lender and certified mortgage planning specialist. Thanks again for watching. Good selling out there. If you need anything, email me back. I've got your back here at kevinbrierton.com, or you could text or call me at 480-553-8770. Have an awesome day. Take care. Bye.